All right, welcome back to the deep dive. Today is Monday, February 2nd, 2026. And I have to say, looking at the markets over the weekend, I actually felt relaxed.
Relaxed. I mean, that is a dangerous word in this business.
I know. But hear me out. I opened my portfolio app, I braced myself for impact, and, well, nothing. It looked completely boring. The S&P 500 was basically a flat line, down just 0.43%.
Barely a blip.
And the NASDAQ, same story,
Yeah.
down about 0.94%. It felt like Wall Street just decided to take a collective nap for the week.
It's amazing, isn't it, how misleading a weekly closing price can be?
So you're saying I'm wrong?
I'm saying you couldn't be more wrong. While you're looking at that calm surface, underneath there was this violent struggle going on. We're talking about a week that might go down as a pivot point for the entire year.
Okay, you're killing my vibe here. I see flat numbers, you see violence. What exactly did I miss?
You missed a flash crash in the metals market. You missed a massive shakeup in currency expectations. And you missed a signal that the entire software industry might be facing, well, an identity crisis.
An identity crisis?
The big one. And it's all connected. Our mission today is to pull back that curtain. We're working off a really dense stack of notes, primarily from the Money Pulse newsletter. We need to talk about why gold plummeted, why people are still buying iPhones, and this really fascinating tug-of-war happening between AI and, believe it or not, the energy grid.
I love a good tug-of-war. But let's start with the scary part. You mentioned a crash. Now, looking at the data right here, gold ended the week at, what, around 47, 46? That looks fine.
And that is why you should never just trust the closing bell. If you were trading on Tuesday or Wednesday, it felt like the floor fell out of the world. We saw gold futures drop nearly 5% in a single session.
5%.
And silver was even worse. It slid more than 9%.
Wait, 9% in a week for silver? That's a volatility. That's a collapse.
Exactly. At one point, spot gold fell all the way to around 45.60. For an asset that is supposed to be your safe haven, I mean, that is a massive liquidation event.
Okay, but why? What happened? Did we find a new mountain made of gold somewhere? Why would everyone dump their safe asset at the exact same time?
It wasn't geological, it was political, and it boils down to two words.
Yeah.
Kevin Warsh.
The nominee for Fed chair.
Correct. President Trump nominated Kevin Warsh to lead the Federal Reserve.
But hold on. I get that the Fed chair is powerful. But does one guy getting a nomination really justify a 5% drop in gold? That feels like an overreaction.
It's not just about the man, it's about the regime change he represents. Markets are forward-looking machines, right? They don't price in today, they price in what they think the world looks like 6 months from now. Right. And Kevin Warsh has a very specific reputation.
Which is?
Hawk. Disciplined. Hard money. The market looked at that nomination and said, okay, the era of easy money is over. They expect a firmer, tighter monetary policy.
And tighter policy means a stronger dollar.
Precisely. And this is the classic seesaw. When the U.S. dollar flexes its muscles, commodities priced in dollars, like gold and silver, they get pushed down. But what we saw wasn't just a repricing, it was a liquidation.
Explain that difference for me. What does a liquidation look like on the trading floor?
Okay, so imagine a crowded theater where everyone is sitting there betting that gold will go up. Many of them borrowed money to buy that ticket. That's leverage. Suddenly, the Warsh alarm rings. The dollar spikes. The price of gold dips just enough to trigger their margin calls.
So their brokers call them up and say, put up more cash or we sell your position.
Exactly. And they don't have the cash. So the broker sells. That selling drives the price down further, which triggers the next guy's margin call. It cascades. That's why you saw that violent drop intraday. It was an unwinding of over-leveraged bets.
So it wasn't that people stopped liking gold, it's that they were forced to sell it.
Bingo. And it wasn't just gold. This fear spilled over everywhere. It hit global equities, it hit Asian markets, and it definitely hit crypto.
Yeah, I noticed Bitcoin was having a rough time.
It's been struggling for 4 months now, trending downward. It was trading near 77,700 last week. The source material makes an interesting point here. When liquidity dries up, when that Warsh Effect hits, risky assets are the first to get thrown overboard.
So big picture time.
Yep.
We have a new sheriff in town at the Fed. We have a stronger dollar, commodities crashing. It's bad. It sounds painful.
It is painful in the short term. Volatility is never fun while you're in it. But the analysis in the Money Pulse actually takes a pretty constructive view of this.
Really? How do you spin a crash as constructive?
Well, think about the alternative. If the market thought the Fed was going to be weak or let inflation run wild, gold would be skyrocketing, but the real economy would be rotting from inflation. By selling off gold and buying the dollar, the market is essentially voting. It's saying, we believe this new Fed will be disciplined.
So they're buying into stability.
Exactly. A disciplined Fed lays the foundation for stable inflation and real growth later. It's the bitter medicine argument. You take the nasty shot now so you don't get sick later.
Fair enough. So Wall Street is taking its medicine. But let's step away from the trading screens for a second and look at Main Street. Because while the traders were hyperventilating about silver prices, it seems like regular people were doing something very different.
They were shopping.
They were buying iPhones, a lot of them.
And this is the contradiction that just defines the week. We have macro fear, but micro resilience. Apple just dropped their earnings, and it was a blockbuster.
I saw the headline numbers. It was the best quarter ever for the iPhone.
In history, iPhone revenue hit $85 billion. That is a massive jump from $69 billion the year before.
That is wild. We keep hearing about how the consumer's tapped out, credit card debt is high, everything's too expensive. How are people finding $1,000 for a new phone?
It's the hierarchy of needs for the modern consumer, isn't it? You might skip the fancy dinner, you might delay buying a new car, but the phone is your lifeline. It's your office, your entertainment, your social life.
It's non-negotiable.
It seems so. The upgrade rates were very high. But there is a specific detail in these earnings that really shocked the analysts.
Don't tell me. China.
China.
I feel like for the last 2 years, every story I've read is Apple is doomed in China, Huawei is taking over, patriotism is driving people away from U.S. tech.
That was the narrative. But the numbers just blew that narrative out of the water. Revenue in Greater China rebounded to $25.5 billion. That's up from $18.5 billion a year ago.
That's not a small bump. That's a resurgence.
It is. And it tells us something really important about the global economy.
Yeah.
Despite the geopolitical tensions, despite the trade wars, the Chinese consumer still wants the best tech product available. And right now, they're deciding that's the iPhone.
It's reassuring, in a way. It's a sign that the global consumer isn't dead.
Far from it. And Apple saw growth in Europe and the Americas, too. So if you're looking for a recession signal, you're not finding it in Cupertino.
Okay, so we have the Warsh panic in metals and the iPhone boom in consumer tech. But I want to spend some time on the third story in our stack, because this one felt the most futuristic, or maybe ominous.
It's certainly the most complex. We need to talk about the software industry.
And specifically, the debt. Now, usually when we talk about tech, we talk about stock prices going to the moon. But the source material was flagging a big problem in the software credit markets.
Yes. And to understand this, you have to understand the difference between a stock investor and a debt investor.
Break it down for me.
Okay. A stock investor is a dreamer. They buy a share hoping it goes up 10 times. They are optimists. A debt investor, someone who lends money to a company, is a pessimist. They don't care if the company conquers the world. They just want to make sure they get their money back with interest. They are risk averse.
The bankers.
The bankers. And right now, the bankers are terrified of software companies.
Why? Software is usually the golden goose. High margins, recurring revenue.
It was the golden goose. But then AI arrived. And now, those debt investors are looking at traditional software companies and asking a terrifying question. Will this product even exist in 3 years?
Obsolescence risk.
Exactly. Look at software as a service, or SaaS. The whole model is, I build a tool, and humans pay me a monthly fee to use it. But what if AI becomes the tool? What if an AI agent can write code, design graphics, or manage payroll better and cheaper than your software?
Then I stop paying the subscription.
And the company stops being able to pay its debts. That is what the credit market is pricing in right now. Software debt is underperforming everything else. It's delivering the weakest returns because the lenders are demanding higher interest rates to cover this risk.
That is heavy. It's like the market is betting on the extinction of the middleman software.
That's a great way to put it. But here is the paradox. At the exact same moment that investors are fleeing software debt, they are throwing money at something else.
Solve Energy.
Right. Solve Energy is launching an IPO, looking to raise over $500 million. And their pitch isn't, we have a cool app. Their pitch is, we have power.
Because AI needs juice.
Massive amounts of juice. Data centers running these AI models are incredibly energy hungry, so the market is making a fascinating switch. They're saying, we don't know which software company will survive, but we know they all need electricity.
It's the ultimate picks and shovels play. Forget the gold, buy the shovel, or in this case, buy the power plant.
It's a shift from the digital back to the physical. We spent the last decade valuing code, now we're valuing kilowatts. The source mentions Solve Energy specifically capitalizing on this surging power demand. It's basically a bet on the infrastructure of the future.
It's not just IPOs. We're seeing mergers too, right?
Yes. There was a notable deal mentioned, US-based Aura buying an Australian company called Korea. They paid double its market cap.
Double. That's a serious premium.
It is. They're building a digital safety giant. And this reinforces the theme. If you're a software company right now, you have two choices. Get massive or get eaten. Aura is choosing to get massive. Consolidation is the only defense against the AI wave.
Get massive or get eaten. That sounds like a nature documentary.
It's not far off. The ecosystem is changing violently.
You know, speaking of ecosystems changing, there was another connection in the notes that I almost missed. We talked about Apple rebounding in China, but then I saw the data coming out of the UK.
The UK manufacturing numbers.
Yeah. I usually glaze over when I see PMI data, but this seems significant. The UK manufacturing sector hit a 17-month high.
A reading of 51.8, to be precise.
Yeah.
And remember, anything over 50 means growth. But you're right to connect it. The driver wasn't just British people buying stuff, it was export demand.
So people in other countries buying British goods.
For the first time since 2022. And look at who was buying. Orders came in from Europe, from the US, and crucially from China.
So the pipes are thawing.
Exactly. If you put the Apple China numbers next to the UK export numbers, you start to see a picture of global trade waking up. We spent so much time talking about deglobalization. But here is hard data showing that the US, Europe, and China are still doing business with each other.
And that has to be good for jobs, right?
It is. The UK data showed job losses slowing down. It's a stabilization signal. So while the financial markets were having a panic attack, the actual factories and supply chains were having their best month in nearly 2 years.
That is such a vital distinction. The stock market is not the economy.
Never has been, never will be.
Before we wrap this up, we have to touch on the quick hits. A little housekeeping. Apparently, the U.S. government decided to shut down again.
Almost like clockwork. Yes, another government shutdown.
Should we be worried? Or is this just political theater?
The sources are treating this as pure noise. The expectation is that it will be resolved in a few days. The market barely flinched. It's become so routine that it's priced in as an annoyance, not a crisis.
Good to know. And finally, let's close the loop on the scoreboard. Who are the actual winners last week?
Communication services and energy.
Energy makes perfect sense given the Solve Energy discussion.
Exactly. Energy was the safety play. Healthcare, on the other hand, pulled back the most, and obviously, metals and mining stocks took a beating.
Winners and losers, the wheel keeps turning.
Always.
So let's try to synthesize all of this. We've covered a lot of ground. We have a boring index masking a violent rotation. We have Kevin Warsh scaring the gold market but maybe stabilizing the dollar. We have Apple proving the consumer is still alive. And we have this massive existential shift from software debt to energy infrastructure.
It's a transition week. That's the best way to describe it.
A transition to what?
I think we are moving from an era of code to an era of consequence.
Ooh, explain that.
Well, look at the last 10 years. The easy money was in writing code. SaaS companies with high margins, infinite scalability, low friction. It was light. It was airy.
And
now we're looking at the consequences of that tech. AI needs massive physical power consequence. The Fed is tightening money to fight inflation consequence. We're moving back to the physical world. Real commodities, real energy, real manufacturing exports.
That's a huge shift in mindset for an investor.
It is, and it brings me to the question I think every listener needs to ask themselves this week.
Lay it on us.
We talked about Solve Energy versus the software debt crisis. If AI is truly going to automate software creation and the constraint is going to be electricity, are we witnessing the end of software as a service dominance and the beginning of infrastructure as king?
Infrastructure is king.
Think about your own portfolio. How much of your net worth is tied up in companies whose primary product is code? And how much is tied up in the stuff that runs the code? Because if the value is transferring from the software layer to the physical layer, that is a once-in-a-generation wealth transfer.
From the cloud down to the power plant.
Exactly. We might be watching the bubble burst for the middlemen of the digital age, while the foundation becomes the most valuable real estate on Earth.
That is terrifying,
Yeah,
but also incredibly clear.
it's something to chew on, at least.
Definitely.
Yeah.
Well, on that heavy note, go check your portfolios, maybe look at some energy stocks, and don't panic if gold has a bad day. It's all part of the process.
It certainly is.
Thanks for diving in with us. We'll see you next time.